So with that, we'll get things going with our first speaker. We're fortunate to have Lee Schulz. Lee is an associate professor in the Department of Economics at Iowa State University, and he serves as a statewide specialist in livestock economics and marketing. His area of expertise is in the production and marketing analysis, risk management for both the hog and beef side and sectors. He grew up in central Wisconsin on a diversified crop and livestock operation. He went to University of Wisconsin River Falls for his ag business bachelor's degree, received an MS at Michigan State, and a PhD in ag econ here at Kansas State University. Lee is also part of a new project. We were actually, a few of us were up in Ames last week. We're starting a new 5-year survivability project sponsored through the National Pork Board. Lee is the lead on our ag econ side with that, as K-State and Iowa State and Purdue have a joint project over the next 5 years, and he'll serve a valuable role in bringing the economics to the different aspects that we're going to work on with that. So with that, I'll turn things over to Lee to get started with his information. Let's give him a round of applause.
I usually fall off these things, so I'm going to go on the ground. Well, good morning. Thank you for having me. It's great to be back. It's the second time I've been back to Manhattan since I went to Iowa State, and the only time actually someone's invited me back. So even my own department, I've never been back for a conference. So I thank the Animal Science Department for having me out here. Thought maybe a good way to look at this is where the industry has gone from when I left Kansas State to when I got to Iowa State. And I want to say I don't take any credit for this, but just look of the tremendous change that we've seen in the hog industry, and probably things that we didn't really anticipate back in 2012, both the opportunities and challenges that the hog industry did face. So increasing hog slaughter, 11 million pigs, production, over 3 billion pounds more of pork produced. When I got to Iowa State, we had $6, $7 corn. Now we're half that. Soybean prices have also declined. We've seen lower prices. A lot of that's due to more production, but also the trade issues that we've seen this last year. Actually, prices were going to be quite a bit higher, at least futures suggested that, and then we had the trade conflicts and what that did to prices. I think what we learned was American consumers love bacon, right? We eat more bacon and we pay more for it. That's really been a success story. We've seen some periods of strong demand, but we've also seen some challenges in the pork industry. So what I want to do is, let's look at now 2018 or 2019. What are the factors that may shape the hog industry for the next year, the next 5 years, the next 10 years? I think you have to start with the production situation, and production last year, red meat and poultry production in the United States hit a record at 100 billion pounds. The beef industry, the pork industry, the poultry industry all contributed to that record production, and we've seen large production here the last 5 years to the tune of about 12%. The pork industry on a percentage basis leads that, a 15% increase since 2014. Consumption has been a positive story, too, for the U.S. As we've seen the economy continue to improve, as production has increased and prices have decreased, we've seen consumers willing to eat more protein. And they've eaten a lot more beef, they've eaten a lot more pork, poultry, and even turkey, all the way to the tune of about 8% increase in that red meat and poultry. But that's behind us. And I think what's instructive to look at is projections moving forward as far as that production and consumption. USDA puts together 10-year forecasts. I like to use their forecasts because then you can't blame me if my forecasts are wrong, right? Every economist, they're going to be wrong about half the time, but here we can blame USDA. They put out some 10-year forecasts and suggest production for red meat and poultry is going to continue to increase the next 10 years, about 7.5% when we look at it in aggregate, and pork production between pork and broiler is going to be the leader in increasing that production. So if we take that as true, let's just believe that is true. I know there's going to be situations that could make that larger, make that smaller, but let's look at that as we're going to see that production increase. And also take their forecast for consumption. You may see a little bit of a mismatch there, right? That consumption is relatively flat, especially when you look at in aggregate and then even across the various sectors. Maybe pork is the most bullish in any of those, but the production forecasts are outpacing the consumption forecasts. Now, one, consumption isn't demand, right? So demand is consumption at what prices I'm paying for it. So that's important. But also, I think this isn't a bad situation for the pork industry. Before you kind of run me out, listen to why that might not be so bad. How could you increase pork consumption considerably? Cheap price, right? So if I have a pork chop or a chicken breast and they're the same price, what are a lot of consumers going to eat? They'll eat poultry, but they're also going to eat more pork, right, if it's at the same price. There's divergence in those prices, and some price-conscious consumers, they buy more poultry, but when you put that at similar price, you could get an uptick in pork consumption. But that's not necessarily good for the pork industry, right? Because you'd have to lower that price considerably to clear more and more production. So I think what we need to really look at is how do we grow pork demand, or how do we hold that consumption where it's at and maintain that price. We've seen successful stories of that here over the last decade or so. 2012 to 13, 13 to 14, 14 to 15 were tremendous demand shift years when we look at pork consumption and pork prices. We've entered a period here where we've seen a bit of a wane in that pork demand. Yes, we've eaten a little bit more, but consumers are also paying lower and lower prices for it. Some of that is because of that increased consumption. We need to find that market clearing price. But I think we're going to get to a point where all the meats are kind of coming together in price, and we're going to start competing more on quality and other non-price characteristics like convenience, serving really the next generation, the millennials. I think that's why we've put so much effort in, that's how we're promoting pork demand, beef demand, whatever demand you're really looking at. So that's one part of the story, and I think the story there is hold that consumption, how do we increase that demand? But I think exports are probably even more important in this story. Exports have increased tremendously for all major meats, to the tune of 6%, but most of that has been in beef and pork. And forecasts are for large shifts in those export markets. So we're going to continue to produce more production, and who's going to absorb that production? Our key and emerging export markets, at least what these forecasts suggest. So what did we see impact these markets this last year? We did a study at Iowa State University. It was right in the heat of the battle of the trade conflicts, right when the retaliatory tariffs were put in place in July and August. And you've seen what it did to futures prices. Significantly for 2018, the August price really plummeted. You did see some prices rebound after that, but even seen some reverberations into 2019 prices. What did that mean to an individual state like Iowa? So Iowa is about a third of the production of pork in the United States. Well, that major shock to the export market, we calculated costs producers about $18 per head or so on average. That's about 11-12% of the price. So we've seen coming into the year, prices were looking great. We're actually seeing prices increasing. It was actually a really strong buzz demand year because we had more production and higher prices. You can only get that one way. It's an increase in demand. That was a really bullish situation for the pork industry. And then you've seen those prices start to erode and cost the industry, you could say on average in Iowa about $800 million. And then we did some other modeling to kind of check those estimates and those ranges there on your right, which give us a range of about 7 to 800 or 5 to about $900 million. I would say that somewhat maybe that's backed off a little bit because we did see a rebound in prices, and so maybe we kind of sold the news and then bought it back, the reality that exports weren't as bad. But you can definitely say that it was a major impact to the hog market, even the news of the retaliatory tariffs and the impacts on the markets. So looking at an individual producer impact, I forecast profitability returns on a monthly basis. It's a budget model we've done at Iowa State University since 1960, and I use that to look at my forecasts going forward the next 18 months or so. And so back in 2017, kind of late 2017, I was forecasting 2018 to be a pretty profitable year, about profits of over $10 a head or so. And as prices started to erode, you see what happened to profitability over that time period. But also, I think you could say that producers that had done some risk management earlier on in the year maybe didn't receive the lower prices that were actually cash received later in the year. So even though we've seen a large impact on markets or market prices, maybe the financial position isn't quite as bad as that because of some possible risk management that would have been done early in 2018. But overall, we've seen lower than break-even returns, at least estimated by the ISU Estimated Return Series. 2019 going forward, my forecasts are a little bit below break-even on a cash market basis. So I'm not assuming any risk management here. And so we went from a pretty good year in 2017, not a great year, to what we thought was going to be a good year in 2018 to below break-even, and maybe a replay here in 2019. Now, that's maybe not too much of a surprise to some, as we've seen an increase in production. So you would expect that prices would have continued to be bid away because of that larger production. But I think going back a year ago, we were so optimistic about the pork industry and how good prices were relative to the supplies that it is a big shock to the industry, and maybe relative to where we continue to expand our supplies. Another thing that's kind of an artifact of this, but this has been changing, is we've seen considerable divergence in prices received by producers. Dr. Steve Meyer has a real good article in National Hog Farmer that looks at this price dispersion about different ways hogs are contracted. This slide here kind of summarizes that, but relative to negotiated, we've seen a lot of divergence in prices, with most of the formulas pretty much being higher, really going back to 2016 or so. That's instructive for my return series because I use the negotiated price, so that's probably a conservative estimate, but also that some producers likely received higher prices than depending on where you discovered your hog prices. So negotiated, the average price in 2018 was below $60 per hundredweight. You go all the way up to the other purchase agreement, which is cost of production contracts and some other attribute type contracts, and that's about $67 per hundredweight. So big divergence there in where prices have been. As I look forward into 2019, prices on average look to be a replay of 2018. A big part of that is due to much higher prices in August relative to what we've seen a year ago. About a quarter per hundredweight higher over that time period. I still think this is a relatively bullish situation given where our supplies are, and I think where the opportunity potential is in the market. If you look at options prices today, they're a lot more expensive than they were a year ago or 2 years ago. What does that suggest? That there's a lot of uncertainty out there in the market. And I've heard people say, and I would very much agree with them, we could see $20 higher prices for hogs or $20 lower prices for hogs in 2019. We just don't know which one. And that's how you get very expensive options premiums because of the uncertainty in the market. That could be a bullish scenario for the industry, that we have that potential for price inflation, but also a big risk to producers out there that we have that potential for much lower prices. That gives producers an opportunity to mitigate some of that risk if they see opportunities in those current futures prices. Unfortunately, we've seen a little bit of erosion here the last several weeks. I'm focusing, I wouldn't say 100% on demand, but most of when I look at the market, it's demand side oriented. Supplies are not surprising the market whatsoever. Hogs and pigs reports are very in line with pre-report expectations, so we don't have a big change post-report. We're seeing slaughter numbers come in relatively within line with where our expectations are. I like this slide because it gives a little bit of context of how big our inventories are right now. Largest hog inventory in the United States since World War II. We continue to set records every year. So even though, yes, prices are lower than we've seen the last couple of years, given where pork production is, I think that is still a success story. Yes, there's room for possible improvement in prices, improvement in demand, but we've seen U.S. consumers, domestic consumers, absorb a tremendous amount of pork production here the last several years, and it's likely not over the next several. When we look at the supply situation, we've really changed here in the last 5 years. We've seen tremendous growth in the breeding herd, especially over the last couple of years, kind of changed that trajectory. Looks to not be over. Farrowing intentions continue to be year over year up. So I think producers aren't backing off on their stated intentions, their plans for expansion. Big three reasons here. Capital investments that were made in 2014 were tremendous in the industry, and it was because of the money we made over that period. Once these investments have been made and been built, talking about now, so they're coming online now, you need to put as many animals in there to spread those fixed costs over as many productive units, right? And so even though we've seen a pullback in profitability, does not mean producers are going to pull back inventory numbers, because they got brand new buildings that need to be paid off, so you continue to see more and more animals. And probably third, and it took me a while to really get this point, took a lot of producers to really beat this over my head, but I think I was looking at the industry really all wrong. So I also follow the beef industry, and it's you look at cow-calf, you look at feedlot, look at the packer industry, all as kind of separate entities, and the profitability in those entities. Pork industry is much different. There's investment really supply chain wide in that industry. So I think it's unfair to really look at Farrow to finished profits and say that's going to dictate inventories going forward. And so I think when you put all of those sectors together and look at the growth we've seen, one, those businesses see potential still out in the market and are continuing to make those investments, and the comparative advantages those entities have show that they haven't wrung out really all the profits in the industry yet, and will continue to expand really until they do. As far as productivity numbers, we have seen really a step back here the last couple hogs and pigs reports, which has made it a little more difficult on forecasts because we can't just use that 1.5 pigs saved per litter number anymore. We've been below that quite a bit. I think this all might just be an artifact of the current situation we're in. We've had a lot of gilts added to the herd. First litter gilts, I'm not an animal scientist, but they told me those are the lowest pigs saved per litter number usually, or pigs born, or however metric you look at it. So this could be just a short-term impact here, but it has curbed a little bit of the possible growth we could have seen. So maybe a little bit of a natural governor in that production chain. We've also seen a pullback in Canadian feeder pigs. If you go back to 2015, 2016, we added about a slaughter day those 2 years. So not a whole lot of hogs, but when you have a pretty large supply and limited capacity, that was a bit of a strain on the market in 15 and 16. We've started to pull back a little bit of that increase in Canadian feeder pig numbers. Some of it's related to the trade retaliatory tariffs we've had. Some of it's related to just exchange rates, and some of it is just capacity that we have here in the U.S. Put that all together, market hog inventories, we've really set a new path forward for the increases we've seen the last couple of years. Disease impacts have actually last year, and I do want to highlight here, I am breaking the rules. This is data from the Swine Health Monitoring Project out of University of Minnesota. They say don't compare across the years, so I am making that. But looking at that, PRRS was actually one of the highest we've seen since 2011, 2012. So that, again, was maybe a little bit of a natural governor last year. Pig numbers could have been bigger. PEDV has been about the same. Both those disease impacts are lower this year, at least to start the year. Year starts in July for these numbers. Hog weights have very much stabilized, and I think this has really come about because of the increased slaughter capacity that we did have. We didn't need to pull those hogs forward this fall because we had the adequate slaughter capacity, really to the tune of almost 10% increase since 16. Even since 17, we've increased over 2% slaughter capacity. We did actually have 1 day or 1 week this last year that went above the theoretical slaughter capacity we have here in the industry. Slaughter capacity, I'm using Dr. Steve Meyer's estimates here. It's theoretical capacity. You could probably push it higher or lower depending on certain conditions. The industry is in a tremendously better, healthy place now, given where this slaughter capacity has gone. See, we're well below that top blue line, which is current slaughter capacity, all but this 1 day here back in 2018 in December. Slaughter numbers have been up about 2%. Already for the year, they're up 4% for the first few weeks of data that we have. One of the biggest questions I've got for reporters for pretty consistent period of time was about the additional slaughter capacity that we've seen in the hog industry. And my first and foremost answer was this was pent-up demand for hog slaughter. We've increased those slaughter numbers considerably over the last 10, 15, 20 years and really seen minimal growth in slaughter capacity. And that wasn't working for anyone in the industry. It wasn't working for the packers. Yes, they were getting very strong packer margins, but they were missing opportunities to sell pork, right? In a market that was very strong demand. If I go back to my demand chart that I had, it wasn't working for packers because come fourth quarter of the year, if I didn't have those hogs booked, it's hard to get a sale on those hogs. And so that precipitously brought down prices. This has tremendously increased the health of the industry and mostly just a pent-up demand situation. It came about because packers, for the most part, had money to do it with historically strong packer margins. But also, I think it was a view of a long-term bullish situation in the hog industry. That I wasn't only investing for today, I was investing for the future where I expect 10% export growth in the next 10 years. I expect to hold pork demand strong here in the United States. Now, if I look at those current margins, they're bid down quite a bit for packers. Kind of mimics the producer situation. It's not because they're paying more for hogs. So it's not really a supply situation here. Packer margins, like producer margins, are being impacted by the current demand situation. Also, it's being impacted by operation. So, not a surprise to many, unemployment rates are really at the lowest in history right now. Iowa's the number 1 lowest unemployment, where we have packing plants and additional packing plants coming online. Iowa's at 2.4 unemployment. The national rate is at 4% unemployment. This is an impact to packing plants, their ability to get workers, ability to, if I go back to this chart here, a lot of these are looking at possible second shift or ramping up to one full shift, as having an impact there and impacting their cost of production, their efficiency. We've still seen them want to slaughter hogs, though, even with this additional capacity, because I think of that throughput situation. If I need to keep putting hogs through that plant, we've seen Saturday slaughter up considerably since August. You don't slaughter hogs on Saturday unless you really need to, right? Because you got to pay overtime, likely another shift of clean. You got to keep that plant going. A little more expensive to do it. So I think there's still an incentive to slaughter hogs, but it's also being met by a waning demand situation. So I want to really dive into the demand situation here with the time I have left. So it's not so much, anymore the ability to slaughter hogs. When I was at Iowa State, it seemed like that's what we talked about every fourth quarter. And leading up to every fourth quarter, before we had the additional slaughter capacity, was what does fourth quarter look like? Is this 1998 all over again? That's really gone by the side now. And I think now what the chatter is, or what it needs to be, is do we have a home for this additional pork? Because we've shown the ability to slaughter the pork production that we have, and even the growing production that we expect to have. But more importantly, can we find a home for this pork at not a considerably lower price? One signal that we have maintained that movement of pork is pork in cold storage really hasn't built up all too much. So if it was building up, that would mean that we're not sending it out on export fast enough, and we're not eating it here fast enough in the United States. But we've really maintained similar path to a year ago, especially here in the last several months of data, just slightly above 2017 when we look at an annual average. Bellies is the one market I really watch now, because that really is the domestic demand, or really is the barometer for domestic demand. We look at bellies in cold storage. They've been up 90% year to date from 2017. This data only goes to 2017. So some of that, I think, is a natural hedge, right? That we need to maintain more bellies in stocks because we're pulling on that in peak demand time periods. But also, I think it is a signal that maybe now we're starting to build up belly supplies a little bit more faster than demand is going out. The belly primal has definitely weakened considerably compared to the last couple of years. I don't think the belly prices, while it did contribute positively to the cutout of 2017, were that sustainable. At least in the news that I read, you were hearing retailers of saying, well, bacon was a great feature, but I don't know if we can continue to pay bacon prices without changing menu prices. And they don't like to change menu prices. They'd rather change menu offerings, usually. So not necessarily a bad situation that we've seen belly prices come down some, but also realizing that they've come down significantly, and they're going to be dictated by what we have in stocks. If we have 90% more bellies in stocks, I don't know how much price inflation we potentially can see. This is probably my most bearish slide that I have in here. So this is the pork cutout last week of available data that I had. It's $14, $15 lower than year ago levels. So we already talked about the belly. So that's signaling possibly cautious situation with demand in the U.S., but then looking across some of those other primal cuts, I think you can point to the export situation of why we're seeing weakness in those individual primals. Cut out here overall, you can see where it's been the last couple of years. And I think we can't forget about the byproduct either. So this is contributing to the packer margin, right? It's kind of their additional margin that they receive, but also a barometer of where export markets are currently at and those prices that are needed to clear kind of market clearing prices. All right, so exports I want to focus on here. But I do want to highlight this graph. It's actually from my counterpart here at K-State, Glenn Tonzer. This looks at the essential concentration index for exports. So a low number is good, or low line on here, because it means that we have a lot of countries to send products to. And a high number means we have less countries. Being where we're at now, we're in a lot better position to withstand trade impacts, because the second best customer maybe isn't that bad, right? If we lose part of Mexico, if we get more of South Korea, it might be a wash, or actually in the short term, it might be a little bit better because South Korea can pay a little bit higher price. Long term, I don't know how sustainable that is, but short term, I think that's allowed us to a little bit withstand maybe what would have been a bigger impact 10, 15, 20 years ago. South Korea has to be considered really our saving grace here in 2018 and likely going into 2019. Part of it you can point to the Korean-U.S. Free Trade Agreement that was agreed to in principle in March, signed here in September, but put us on a path where we really are today with both beef and pork. So most pork goes there tariff-free. Beef, the tariff's going to continue to go down over the next 10 years. It's put us as the #1 exporter of beef to South Korea and number 4 for pork to South Korea. We need more of these and less of the other issues that we've seen with China, Mexico, and Canada. We're somewhere in between with Mexico and Canada, right? With the USMCA, the renegotiation of the Free Trade Agreement. I think that could give us a little bit of boost if we get that ratified within the government. China, we're a long ways off before I think we're seeing significantly positive news. They have been buying more pork, but we haven't seen really something that's moved the needle considerably. So here is the shares we send of pork, muscle cuts, and variety meats. And why do I give you this chart? Well, I think the big one is, where are we going to see the impact on pig prices? And so when we've seen all this trade conflict, a lot of attention got from China, right? And considerably so. They are really the largest producer, largest consumer of pork, right? But when you look at the percentage of our exports going to China of pork, China is down here at about 7% or so. Mexico, Canada, they account for 40 to 45%. So that was a much bigger trade deal in principle that we got done with our two neighboring countries as far as pork volume trade. Now, I don't know how much more potential we have for those countries, but to hold that market share is very important because of that. It's that big of a slice of our portfolio. Now, China, yes, is a large share of our variety meats, and where you would expect to see the large impact on both volume and prices there. So it's simple economics how trade has really played out here in 2018, and I would suggest it's going to be back in 2019 as well. that over the last 6 months or so, we've continued to see our exports move, but to do so, we've had to move them at a lower price. So exports have for the year are up 5%. Most of that occurred earlier on in the year. Value is still up 2%, but value has significantly eroded here the last several months, and I would say it's going to continue to do that to continue to move the large supply of pork that we have. You think about Mexico a little bit, why they've continued to increase their exports or imports of U.S. pork. They are the Black Friday shopper at Walmart, right? If you get stuff cheap enough, they'll buy it. Not so much hams, like that's a staple product, but they'll really ramp up imports of other products they don't typically do because they have a population to feed if you get priced cheap enough. And you've seen that somewhat with Mexico, but you've also seen this with some of our other countries, emerging markets potentially, where you've seen prices, if they get low enough, they'll buy more pork. That's helped us out in the short term. Again, that's probably not a sustainable long-term strategy. Variety meats are a much more bearish story. So volume down, price down. We have to do really all we can, and it's lower prices to get that product moved to the highest valued market. The lowest valued market is here in the United States. So the highest valued markets ends up being many of these countries right here. Guatemala, Panama, Honduras, Trinidad, Tobago, are where we've seen a large increase of variety meat volume, and they're willing to pay a little bit more for it when you get it cheap enough than they did at least a year ago. Looking at a little bit kind of bearish, bullish story here as far as exchange rates. Mexico, peso, it's continued to really devalue or maintain its devalued status. That's not going to help out their purchasing power all that much. South Korea, that is why they continue to buy product. It's not only because they highly desire our product, but they have a lot of purchasing power to buy more pork from us. And the one I'd have you really watch is the the euro. So as a major competitor on the world market for markets we compete in similarly, the U.S. and they have a relative little bit of a weakening in that euro, which is going to make their product a little bit more cheaper relative to the U.S. And also worrying about they're starting to get momentum to gain some preferential access to some markets that we could see some impact, or at least a little bit of impact, if we don't maintain that similar market access, like Japan potentially. China has really benefited from the suck that China has on ramping up imports as well. But long term, probably my most bullish chart here. Cost of production, no one competes with the United States. So when you look at a very safe, quality, consistent product that'll compete with anyone, and also price, this is going to put us really in any export market fight that we want for maintaining market access. If you look at the pure economics of it, I know there's some other barriers that potentially exist that keep us out of markets, but overall we can deliver some of the highest quality products at the lowest price. I want to end with probably the most uncertain thing in the outlook, and it's the situation in China. One, because China, even the data that's reported, we don't know how true it is and how much of the fact it is, but also because it's such a big market player in here, and they're facing a situation that we really haven't seen before with the impact of African swine fever in China. This is some data that I got from a colleague that from China, looking at prices by region over the time period when we had the first case outbreak and then when we had shipping restrictions. So I want to kind of build the story of where they're currently at right now with price, and hopefully end at, is there an ASF market premium currently out there? So overall, we've seen price divergence to places where their pork deficit, because I have shipping restrictions, we're seeing higher prices, and where I have pork surplus, I can't get the pork out of the region, we're seeing prices plummet. Overall, prices are up about 5%. Hog prices, this data was through November. Pork price, retail, is up about 7%. So it says demand is maintaining pretty good because prices are up. We know there's been somewhat of a supply reduction as well. But we've also seen the red line here of hog prices have really not escalated all that much, and short term have really fallen here the last month or so. So it would suggest, given where supplies are, that there's ample demand there. Or look at it another way, that you don't have too much demand and a limited supply. Steve Meyer had a nice article, I believe yesterday, in National Hog Farmer that kind of summarizes the situation. I encourage you to go check it out. But he cautions really one big thing in that article, which is really bolded here. That yes, you could see a large increase in price with a supply reduction in China. We don't know how big that supply reduction has been. We've heard 6 million hogs or so. That gets you roughly 100 million pigs, if you do the math. But we don't know how big that really is. But if you think a 6 or 10% reduction, if you assume some elasticities, which we don't know those numbers either, it puts you at an increase of about 15% or so in prices. But that suggests that demand stays flat. Now, what if you had a 5% decline in demand? Well, your price escalation just got cut in half. If you had a 10% decrease in demand, you have no price inflation. So that gets rid of this whole, is there an ASF market premium globally out there in the market? Could easily be no if you see demand wane in China. I don't think we've seen that yet, and really it's going to be third quarter before we really see the large impact on hog supplies and prices. So probably too many questions out there still, but I think there are some certainties as we look at the pork outlook. The big uncertainties is the export disruption as it relates to ASF, really any foreign animal disease outbreak. I'm not in the camp that there is a risk premium from ASF out there. I think there's potential, but we don't know how large that supply reduction is and what demand happens in China. Big question really revolves around trade and retaliatory tariffs. Big uncertainty about labor, ability of these plants to really ramp up given the current labor tight supply that we currently have. Pork producers, I've seen the number that you'd need 2 crop failures to get us back to $6, $7 corn. That's pretty bullish from a production standpoint. Knowing your cost of production is going to remain relatively low for the next several years, almost guaranteed unless we've seen a large drought, and it might take 2, I think is pretty bullish for controlling your cost of production. And I'll end with, I think it's not do we have the slaughter capacity anymore, is do we have a market for this large supply? And a market that's going to pay us prices that will kind of reverberate profitability back through the entire industry. So with that, I'll say thank you. So I actually married that girl there. So both K-State fans. So I'll take any questions if I have any, or any time.
You bet. Let's give Lee a round of applause. We have time for a good handful of questions, so we can bring this mic, or if you can speak loud enough, then we'll just repeat it, have Lee repeat the question. So any questions for Lee?
Went pretty fast, so we got a lot of time.
Well, yes, but we also started Economist early, so we knew we could finish on time. No, just kidding. I have to give him that time.
How good's the data on Chinese slaughter on a weekly basis?
Terrible. Well,
To repeat the question.
oh, so how good's the data on Chinese slaughter? You know, that's data I haven't worked with as much, but you know, if you take it in the same vein as the production data, and maybe it's a little bit better than that because I think it's easier to measure pounds than hooves, right? But you know, realizing the production data, we have such wide variation in it, and you really never see the rectification of, you know, slaughter versus numbers, and I think there's a reason for that. They don't want you to know, right? And so you know, slaughter numbers, I would say they're better, but I don't know if they're that much better than the production data that we actually have. You know, I will say the 6 million breeding numbers that were slaughtered, you know, that data, I haven't been one to give that estimate, but I've seen a lot of analysts that use a lot of different data. Some of it's slaughter data, some of it's, you know, some other data out there, that they all kind of arrive at that 100 million number. And so, you know, I think that if you're going to put a little credence in kind of an impact production-wise, you know, it may be that 100 million, but it might be plus or minus 20 or 40 million. I really don't know. Okay.
Lee, one of the things that, and I might have missed it if I didn't, but when you talk about, we obviously have more sows, you know, as you kind of set the stage, you know, to spread fixed costs where profitability has been stagnant here recently, but we're still getting more sows, producing more pigs. From the backside of the carcass weight trends have continually been on the increase. What has been the last few years or projected this year on the slaughter weight side? That ultimately also impacts the amount of tonnage on the market.
Yep. So I think you've seen that moderate growth of the, you know, about 0.5% or so the last couple of years. You know, but you've also seen major impacts on that. I think when you had PDV, there was an incentive to really increase those weights considerably, right? Because I could sell more at a higher price. I had more kind of bunk space or facility space because if I had any death loss. Also, you've seen relatively cheap feed costs over the last several years. But also one factor that's pulled kind of on those weights to keep them lighter is pretty strong demand for hogs. And so packers have really gone after hogs at key times and it's kind of kept a lid on increasing those weights. You know, I think going forward you would expect kind of that continued growth in productivity, barring really expensive feedstuffs, really, of course. But you know, those pounds add up too. Another 0.5 pound or so on 27 billion pounds, that adds up pretty quick.